I would think probably the best way to think about it is that hybrids sit somewhere between senior and equity. Now, where they sit between senior and equity will come down to the terms and conditions of the securities, whether they can miss coupon payments or have conversion to equity. But that's fundamentally the difference, is that senior credit will always just get maturity. With a hybrid, you basically have terms where they can be called earlier, or they could actually convert to equity at some point under certain conditions. And and fundamentally, they always sit above equity because equity holders, as we always say, get the blue sky. Hybrid holders and senior holders, they just want their money back and their coupons, which is really, really important. Hybrids are a passion for me. I've been involved with them since the mid-90s, and probably they're not really well understood by the marketplace, even though retail do invest in these securities. And I think the most important thing, from a research point of view for us is that, I was taught at a very early stage in my career and never assume anything. So reading the terms and conditions of a hybrid is really important. But the role they play for us is that they give us good sector exposure, because we just don't even, hybrids aren't, banks, insurance. They can also be issued from corporates, for the corporate sector. So we tend to, use use hybrids for our diversification purposes. But more importantly, they investing across a capital structure of a company gives us that ability to find value. And we have pretty much one rule as an investor, especially in the enhanced income fund, but across all our credit products, is to get paid for the risk that we're taking. And I think that's really, really important. So, and we can touch on this a little bit later, but we look at senior credit from a bank. We look at tier 1, tier 2, but we're always trying to strive to find that best value. Because the worst thing you can do from a credit point of view is to actually invest and not get paid for the risk that you're taking. Every company we invest in, doesn't matter if it's a hybrid, but anywhere we're lending money or investing with a company, we will always look at the financials, the ESG of a company, the business profile and the market, where they sit in the market. And that's really important. And I talked about experience, but I'm very lucky that I've got an experienced credit team who all contribute to that credit process. And I always say it's not set in stone. We're always looking for ways to improve. So from my perspective, I think it's really important that we look at companies, look at cash flows and value companies the way we want to, not how other people do. And what we find is that by signing a Yarra rating, we're taking everything into consideration, and we're forming a view on that company, which could have inputs from our equity team, which is also quite unique to our process, is that we work very closely with our equity team. But I think the thing about that Yarra rating is we apply that to the senior level, and then in the case of hybrids, we will actually form a view of things like the ability of the company not to pay a coupon, where you sit in the recovery if a company was to move into default. So all those things. So we apply that senior rating, but then we will actually look at the terms and conditions of a deal and assign a rating to that subordinated, whether it be tier 1, tier 2, or even just subordinated debt. And that's really important to form a view on how you see those terms. I think if I look back on the first quarter of 2022, I think it's for the first time in probably my career managing enhanced income fund, I've actually bought Bank Senior, Bank Tier 1 and Bank Tier 2 paper. And I can't remember a period where I've done that. And it probably highlights, to me and where we've got to in markets in 2022. At some point, getting paid for that risk, has shown that at some point during the quarter, we felt senior was really cheap, and hence we invested there. We exited. We moved into some tier 1 of the Commonwealth Bank, and then moved into tier 2 later on in the quarter. And I think that that highlights that having an open-minded, flexible approach to investing in a bank capital structure, gives you that flexibility. I have a rule of thumb that probably a lot of people out in the marketplace do as well, but I have a rule that to move from senior credit to tier 2, I want to double the credit spread that I invest in. And then to move from essentially, senior to tier 1, I want to get 4 times the spread or double the tier 2 spread to tier 1. That rule of thumb has served me very well to identify value over a period of time. And having that ability to rotate along a bank capital structure is really, really important. So this quarter I bought CBA Senior, CBA Tier 2 and CBA Tier 1, which is quite unique. Senior unsecured issued by a bank, generally, the maturity is defined, has no extension risk, no ability to convert to equity. If I bring it back to a rating perspective, is AA minus from a bank's perspective. So really high quality. Today trades at around 83 basis points over what we'd call swap. So how much return credit spread that we're returning. So tier 2 today for the same Commonwealth Bank security, and I keep using Commonwealth Bank because they had recent issues that we invested into, but that we picked that up at 190 over. So what's different between senior and tier 2 is that they have an ability to convert to equity, mainly on the ability to non-viability. So definitely much more risk than senior, hence why you're getting paid 190 versus 83, and essentially at a ratio of about 2.3 times looks pretty good. So then to move into tier 1, you introduce the ability of a bank to miss a coupon, or in a hybrid case, ability to miss a coupon. Conversion to equity on non-viability based on defined conversion terms. But you also have another introduction which can be if a bank's capital falls below 5 1/8. And if that happens, then you also could be converted to equity. But in my view, Australian banks are of the highest quality, and to get more compensation by investing in a major bank tier 1 and tier 2, it's probably the cheapest form of enhancing your return, because fundamentally they are quality businesses in an equality economy. And in my view, if there is any sort of times that it can get tough, equity holders will fundamentally fund the banks, which I think is, as I say, a great way to enhance return in something like the Enhanced Income Fund.